Welcome to Small Practice Support Information Session number 64. In this recording, Michael O'Scahill of accountancy firm Crowe provides Justin Purcell with annual tax return advice and also a review of the recent budget.
We've just come up to 1 o'clock. We might as well get started. We've got limited time. So I'll just formally introduce Small Practice Information Session 64, Annual Tax Return Advice and Budget Update with Michael O'Scahill, who's Director of Taxation at Crowe. So Michael, you're very welcome to join us today. If anybody would like to ask Michael a question, we'll take it on the chat. Over to you, Michael. So I suppose my first question to you is, what did you think of the budget?
Well, I suppose the best way to sum it up is it didn't have the drama of some budgets of previous years, or going back, maybe we have to go back a number of years now to find a really dramatic one, but there's nothing dramatic about it. But at the same time, it's probably not right to describe it as a holding budget either. There were actually a couple of initiatives introduced, maybe a little bit of something for everybody in the audience to a degree. We saw, like, as I say here, we've income tax, for instance, we did see some changes for the first time in about 3 years. The last 2 years was very much pitched at we're just playing for a draw, if I can use an analogy, and just keeping it steady as we got through things like Brexit and COVID-19 and so on. But they have actually introduced some changes to income tax this year, not to the headline rates, but to tax bands and credits. And that's important because while they were frozen over the last 3 years, the impact of inflation and pay increases and so on meant that by doing nothing, the government were actually collecting more tax because people were being pushed into the higher tax bands and so on, and the government collected more tax naturally through the impacts of inflation and pay increases. So I think people will welcome the index linking of these. The band has gone up by €1,500 for everybody. And that means, in simple terms, anyone who's earning more than 35,300 can earn another €1,500 before they pay the 40% tax. They'll pay 20 instead. They've also, that's the first time in 3 years that's changed. They've also increased the credits now by a modest €50 a pop. But if there are any tax historians amongst you, you might be interested in knowing that the last time the tax credits changed was 11 years ago. It was in the infamous IMF budget, as it's known, in December 2010, when they slashed them by 10%. And they've actually been at that level ever since. So this is the first increase we've seen. So the personal credit, the PAYE credit, and its sister for the self-employed, the earned income credit, have all gone from $1,650 to $1,700. I know a lot of our audience today will have been interested in the earned income credit because for many, many years, there was a discrepancy there, or a disparity in the treatment between PAYE employees and self-employed people. The PAYE employee got this extra credit of $1,650, whilst the self-employed got nothing. They started to remedy that about 5 or 6 years ago by introducing the earned income credit, and they gradually equalized it by 2019. And now it's going up in tandem with all the other credits as well to $1,700. So, there are some welcome changes there in that regard. I think the one a lot of people would have been interested in, and you might argue it's a bit of a damn squib at the end of it all, but it's working from home credits, because obviously in the times we live in, this is very, very topical. Now, if you have an employee and you decide to pay them, and they're working from home, and you decide to pay them kind of like a daily stipend or an expense amount to cover their costs at home, you can pay them up to €3.20 without it being subject to income tax, PRSI or USC. But I suppose most employers won't do that because the costs will quickly rack up. So what typically happens is the employee himself or herself instead claims a tax credit in their tax return. And unfortunately, this is more cumbersome. It's not a case of claiming €3.20. You have to claim a percentage of your light and heat bills and a percentage of your broadband. And up to now, we've been relying on revenue guidance, which stated that they accept that 10% of light and heat and 30% of broadband costs is considered the norm. And furthermore, they've actually said that broadband isn't normally a working from home expense because you're going to pay broadband anyway, is the theory. But they say, well, for the duration of COVID-19, we'll allow you to claim it. The budget announced that this will be put on a statutory footing. The 30% broadband, it will now be in law, and the 10% light and heat is to be increased to 30%. You do also have to time apportion them, multiply by the number of days that you work from home during the year divided by 365. So just be careful about things like weekends and so on, because they're typically not working days. So when you're doing your 2020 return and you're claiming it underneath your 2021, you'll have to use the old 10% and 30% rules. But going forward from next year, hopefully the credit will be on a statutory footing and you'll be claiming 30% of your light and heat and your broadband. But it'll work out, and then you put it in as a deduction in your tax return. You hopefully get 40% tax relief on it. You don't get USC or PRSI back. What's it going to be worth? Depends, I suppose, how many days you work from home and what your bills are like. But you're probably talking about it being worth in the region of 80, 100 euro, that sort of thing. So it's pretty modest. I think some people are disappointed they didn't go a little bit further, you know.
Yeah, it seems tame enough.
Yeah. Another topical area, I suppose, is the whole area of electric vehicles and kind of green taxation, if we like. And since 2017, 2018, we've had a special treatment of electric vehicles. If you buy an electric vehicle for your employee, provided that they cost less than 50,000 euro, that the original market value rather was less than 50,000 euro, there's no BIK. If it costs more than 50, you only pay BIK on the surplus. So that's attractive. A lot of employers have actually gone for those as company cars. That was to run out at the end of 2022, but they announced in the budget that they're extending it for another 3 years to 2025, albeit they will gradually taper it downwards between 23 and 25. So I think it'll be reduced to 35,000 and then 20 and then 10,000 to 2025 and then it'll be gone. And just be careful, I suppose, with existing electric vehicles as well, that the exemption will run out on those at the end of 25 as well as things stand. So but that's right. The other thing that's attractive about electric vehicles that might actually be more relevant to some of our audience today is there's an accelerated capital allowance available on them. So typically, if you buy a car for your business, you'll claim, so say as a self-employed person, you'll obviously claim a percentage of your fuel and a percentage of your servicing costs and all of that. But you're also entitled to claim a capital allowance on the actual cost of the car. And the way that works is it's linked to the emissions of the car. So it has to be a low emissions car. And if it's a low emissions car, you can claim the full cost of the car, but capped at 24,000, but only over an 8-year period. Whilst if you buy an electric vehicle, you can claim the cost of the car, albeit capped at 24,000 in one go. Now, most electric vehicles obviously cost more than that. So what you typically would find is you'll get a write-off of 24,000 in your tax return the year you buy it. Now, again, it will have to be apportioned if you're a self-employed between your business and your private use. But, there's a tasty enough write-off there. So it's something maybe you might be interested in considering if you're looking at buying a new car. There are grants available as well for electric vehicles, I suppose. So something I think to consider. We've also had other accelerated capital allowances on certain other energy efficient equipments have been extended out to 2024. And if they're directly operated by fossil fuels, the allowance won't be available anymore. So again, all very much in that whole area of green taxation. I suppose in the area of COVID-19, they announced that the employment wage subsidy scheme, the EWSS, that was due to run out on New Year's Eve. It's being extended for another 4 months. That was kind of well flagged, but it will be tapered. So it was actually meant to be, the tapering originally, according to revenue during the summer, was meant to start in October, but they confirmed in the budget there'll be no change in October, November. But then December, January, February, we'll actually be back to what the EWSS was originally meant to be, which was a 2-rate scheme of €151 or €203 per week, depending on the salary level of the employee that was covered. So the days of the €350 are gradually being wound down. And those 2 rates will apply in December, January, February. And then in March and April, it'll be a flat subsidy of €100 per employee. And also for March and April, the special PRSI treatment will no longer apply because people tend to overlook that maybe. In addition to getting a subsidy from the government, anyone who's on EWSS, any employee who's on the EWSS scheme, you only pay 0.5% employer PRSI on their entire wage, not just the subsidized element, rather than potentially 11.05. So that's one to be wary of. So it's good that those things are being extended, but just be careful that they're being unwound. Another one that's being unwound, it seems, is the waiver on business rates, which is applied broadly since Q2 2020. And it looks like that will run out as planned on the 31st of December. I think the last thing on my slide there is what we were talking about, Justin, at the outset, the EIS changes for financing businesses, and like we await details in the finance bill on those, but I know there are a lot of people eagerly awaiting those. I think from the point of view of our audience today, EIS is probably more relevant from an investor perspective rather than a fundraising perspective, and we'll actually touch on that later when we look at the issues to watch out from when filing tax returns. So that's a broad overview of our budget.
Good, very good.
Yeah.
Now, there was a quick question there around the accelerated cap allowance on electric vehicles on hybrid vehicles. And is it available on second-hand electric vehicles?
Yes, it is actually available on second-hand. Yeah, and available as well potentially, because I had this coming up recently as well. What if I buy the car overseas? And yeah, it would be. So again, it's capped at 24,000, but it is available. Yeah.
Okay. Very good.
So it's one to watch out for, certainly. Okay. So that's the budget. Next big item on the horizon then always follows the budget. People start focusing on including tax advisors. We then turn our attention to the pay and file deadline, which is 4 weeks today. So you can imagine all the excitement this time, 4 weeks, as people get those returns in and payments across the line. So 17th of November, we obviously got a long extension last year to December. That's their revenue. I think are adamant. I think they clarified again last week that's not going to happen again. So back to 17th of November. And what you'll be doing on that day effectively is potentially 3 things. Filing your 2020 tax return. So that's your number 1 objective, to avoid any late filing surcharges and so on. Paying the balance of any tax due for 2020. So after crediting whatever preliminary tax you paid last year, and then paying your 2021 preliminary. And typically with your 2020, we'll talk in a minute about how you might manage your tax bill, or is there anything you can do and so on. But once the tax bill is established, the balancing payment is what it is. For 2021 preliminary though, you have a little bit of an analysis to do. How much should I pay? Typically it's 2 choices. You either pay 100% of last year's liability or 90% of the current year estimate. And the general rule there would be, look, if your tax liabilities are going up, if you think your 21 is a better year than 20, you generally would pay 100% to 2020. It's safe, it's certain, you're guaranteed you're meeting your obligation. And also, you're not given revenue money that you'll be getting back off them, because your 21 bill is ultimately going to be higher. If your tax liability is going down, on the other hand, if you pay on 100% to last year, yes, you have the certainty and the safety, but you're probably given the money that they're going to end up paying back to you when you eventually file your 2021 return. So you might then look at the 90% of current year estimate. The third option that's there is a bit of a dark horse every year. Might not be as much of a runner this year when we think it through. It's 105% of 2 years ago, 2019. But in order to do that, you have to have at least 3 direct debits paid in the current year, the first of which had to go through on the 9th of October. So unless you're actually on a direct debit arrangement already, it's too late to do that. Now, I know some solicitors like to just have a monthly payment going through to keep it ticking over anyway. So they might want to look at that option. But is it really going to be a runner this year? Remember, 2019 was probably a good year relative to the last 2 for most people for obvious reasons. But look, it's probably worth having a look at anyway. But then the ultimate joker in the pack here is tax warehousing. Might you actually not have to make any payment in 4 weeks' time and instead warehouse it? And what are the pros and cons of that? And we're actually going to look at that in more detail in the third part of this presentation, because it's probably a particularly hot topic for solicitors, amongst others. How do I reduce my tax bill then? Is always a good question. Well, let's just say you've got the return prepared, you've got your profits there, your taxable profits, your rental income, dividends, whatever else you may have. 2 obvious ways of doing it would be to make an EIS contribution or a pension contribution. Now with a pension, broadly speaking, you can put a percentage of your total income capped at 115,000 though. So your self-employment income essentially from your practice profits, taxable profits up to 115.
Michael, we just missed that last bit there.
15% if you're in your 20s to 40% when you're over 60. Yeah.
We just missed that
there on the pension contribution.
Yes.
Okay. So on the pension contribution, you can make a contribution of between 15% if you're in your 20s, up to 40% if you're over 60 of your taxable profits effectively from the practice, but capped at 115,000. So the maximum contribution someone could make as a 61-year-old with more than 115,000 in profits could effectively make a contribution of 46,000, for example. Now, when you make a pension contribution before the 17th of November, on or before the 17th of November, you can backdate it for tax relief purposes to 2020, and you can get a deduction against your 2020 taxable income and potentially save 40%. Okay, so it can be useful because you're diverting, obviously saving for your retirement as well, and at the same time reducing your tax bill. If you're paying preliminary tax based on 100% of last year, you actually get a double whammy of a benefit because you're now paying 100% based on a lower tax bill as well, having reduced it with the pension. So certainly worth looking at. Yeah.
So Michael, there is a question in there, and it might be worthwhile just treating with it now, is how do you estimate 90% of 2021, and what happens if you end up underpaying because profits increase?
Yeah, and that's what I mean just about the safety aspect. 100% of last year obviously gives you certainty and so on. The 90%, well, I think, again, for a solicitor, it might be more manageable depending on year end. If you have and I appreciate not everybody does have an early year end, but if your year end, for example, is in April, is 30th of April, you'll probably have prepared your 30th of April 2021 accounts by now, or you'll be in the process of doing them in conjunction with your tax return. And therefore, you'll actually know what your taxable practice profits are going to be for 2021. Now, I know there are other incomes you may have, such as rents, dividends, and so on. But anyone with kind of a year end earlier in the year probably is in a pretty good position to do that estimate. I mean, if you're talking about later in the year, if you have a year end of October, November, December, I suppose there is also the element there. You're trying to do management accounts probably up to 30th of September and try and project forward for the year. What we would advise anyone who does go on the 90% basis is it's worth doing a review again, and with where there's uncertainty, someone say with late year ends, is to review the situation again at the end of the year. And if there is a top-up payment required, to make it as soon as possible. But there is a risk element there. Now, if you don't pay enough preliminary tax, what happens is, and they apply interest. It's at a daily rate, but it's at an annual effective rate of 8% essentially. That would be applied from the 17th of November. Strictly speaking, it would actually be applied from the 31st of October, which is the official deadline. The 17th is an online extension. It would be applied from that date up to the date that you finally settle your 2021 tax bill, which will probably be this time next year. So just be careful on that. Yeah. Okay. The other one there, EIS, that I mentioned, as I said, the revenue are trying to, or the government are trying to jazz it up a little bit for companies that are trying to raise finance. For anyone who's going to invest, the big boon from EIS is you can put up to $250,000 now into it in any 1 year. But there are obviously, it is possible, of course, to make smaller tranches as well. You can do it directly in a company that's looking to raise EIS finance, or you can do it. There are a couple of funds out there that will take your money and essentially spread them amongst a number of investments. There are a couple of those well-known funds out there. The idea is that it gets deducted against your taxable income in the year that you make the investment, which would be 2021, the current situation. And if you have enough income at 40% that you're paying 40% on, you essentially save 40% tax. I think with EIS, generally speaking, the view on it would be that if you don't have enough income at 40%, it's probably not worth doing, You also have to consider as well, from an EIS perspective, it's not just a tax investment. You're actually potentially going to lose your shirt on it as well. It's a commercial investment. And it's one thing to put 100,000 into an EIS and say, well, I'm going to get 40,000 back in tax. But at the same time, how much of my 100,000 am I going to get back from the company in due course? What sort of return am I going to make, and so on? The tax relief does give you a cover. It does reduce the cost of the investment. I guess it gives you a little bit of breathing space if it goes south a little bit. The journey from 100 to 60, at least you've got tax relief on that element to cover you, I suppose. But
is it too late to start looking into EIS investments? The level of due diligence that you'd be able to do at this period is
that's
limited.
True. Yeah. I mean, again, at this point, they are being advertised. They're not as common. I mean, the problem with EIS is because of some of the issues that they're trying to address in the budget, the scheme has lost a lot of its luster for companies over the last couple of years. It's quite difficult to qualify as a company, and there are kind of stringent conditions and so on. So they've become less prevalent in recent years. And again, as I say, it is something to be careful about. You're right, Justin. There is a need to do a due diligence and see what exactly you're getting yourself.
Just to be slightly cautious, I suppose. But I mean,
that's right. Yeah.
The main principle is if you can afford to pay it at the higher rate, that's probably the best.
That's the best thing. And remember, if you're talking about making an EIS investment now, what you're going to get relief against is your 2021 income, not your 2020. So you're essentially, the immediate cash flow boon, if you like, will be in having to pay lower preliminary tax for 2021. Because at that stage, you're making it, you're looking at your estimate. You're probably looking at your 90% estimate there as well, because you're basing your preliminary tax in the current year. But you're saying, look, I've got all this taxable income, but I'm actually now putting 100,000 or whatever, 50,000 into an EIS, which will reduce my bill by 40% of that amount. So that's the immediate cash flow benefit from it. But yeah,
listen, Michael, I'm conscious of time, so we don't want to get stuck on the EIS.
Sure. Absolutely, yeah.
There's a question there. Are you going to get a copy of the slides? Yes, we'll send out the slides and a recording on Friday afternoon to everybody.
Other than making investments in pensions and EIS, before you even get to that level, if you look at your accounts, because obviously a solicitor, the bulk of your tax bill is going to be based on your practice profits. And I know I'm saying the obvious, your practice profits will, from a tax point of view, will largely be determined by what your accounts state. And a couple of issues you might look at, or a couple of areas that could be worth looking at, are bad debt provisions and work in progress. So if you look at your debtor's ledger, maybe it's a good time to look at it and review it and say, what am I not actually going to get paid? Or any of these guys not going to pay me? And should I be writing them off or making a provision against them? Because specific provisions for bad debts and write-offs are deductible against your taxable profits. So this might be the time to take a bath on them and take the benefit in the form of a lower taxable profit for 2020 or 21 or both. Work in progress, I know, is a technical area. I know it's not a popular area, but there are obviously detailed accounting principles and guidance notes and that out there in terms of how it's supposed to be valued. The higher your work in progress is at year end, the higher your profit will be. So the question is, within the parameters of the accounting standards and your other requirements, is it possible to defer the recognition of some of that WIP to the following year and therefore potentially give yourself a cash flow boost? You know, the fateful day will come eventually when you'll pay tax on it because you'll have billed it and so on. But there may be scope there to defer it using accounting practices around work in progress.
Probably best talk to your accountant specifically about that.
Yes, that's more an accounting area in the first instance rather than tax. Yes. Yeah. If we talk about tax warehousing, because this is, I think, topical for solicitors in particular. So we've spoken about our 100% and our 90% and our 105s and our bad debts and our pensions and our EIS and all of that. But is there any way you won't actually have to pay the tax in 4 weeks' time? And potentially there is. But be careful. So it's tax warehousing. Now, this time last year, they introduced a tax warehousing scheme for your November 2020 pay and file. And in broad terms, the conditions were that your anticipated income for 2020 was expected to be at least 25% lower than 2019. And that's your total income from all sources. So your taxable profits from your practice, your rental income, your dividends, your salaries, pensions, anything else you may have was expected to be 25% lower. And if it was, then you were allowed to warehouse the tax payments that you were making last November or December, as it turned out, which was your 2019 balancing payment and your 2020 preliminary. They brought in another scheme in last year's budget at the same time for pay and file in November 2021. So you can warehouse your 2020 balancing payment and your 2021 preliminary. And the test for that is that your anticipated income for 2021 is expected to be at least 25% lower than, again, 2019, the last pre-corona year, essentially. And I think they possibly had solicitors and sole traders and that sort of thing in mind when they introduced the two warehousing schemes at the same time. Because thinking about it logically, if you've got a solicitor with a 30 April year end, for example, or 31 March, what you were filing for last year, you're paying your 2019 balancing payment and prelim 2020 based on a March 2020 year end. It was all pre-corona. So a lot of solicitors who are impacted by the pandemic, it's actually in their 2021 accounts that the hit really happens. I think that's why they brought in the second scheme. Now, if you go into the warehouse either on last year's pay and file or this year's pay and file or both, it stays in the warehouse for another year until the end of December 2022, essentially at a 0 rate and no requirement to pay any of it off until then. On 1 January 2023, the doors of the warehouse will open and the debt will come out and it will be payable at that point unless you agree a phased payment arrangement or a PPA with the revenue. Now, if you agree that with revenue, and there's no guarantee that they'll agree, they will look for proof that you are unable to discharge it all up front and that you're good for the deal that you're about to enter into and all of that with them. But one imagines, given the nature of all this warehouse debt, that there will be a lot of PPAs in train. So if you agree a PPA with them, normally the rate is an effective annual rate of 8%, but for the purposes of this scheme, it'll only be 3% from 1 January 2023. So there is some attraction there, I guess. If you availed of last year's warehouse, be careful. Make sure that you actually met the 25% test after all. Just be careful of that, because they can technically, they could come back after you if you didn't. Say, why did you warehouse? But looking at it now, this year's warehouse, or if you've warehoused either or both years, you should be looking at a plan of action now as to how you're going to settle this eventually. It's great that you'll have the 12 months leeway, but what about Christmas Eve or New Year's Eve 2022? So one thing to say here is, if you're going to need PPAs and the like, you'll need to engage revenue at an early stage. So during the last quarter of 2022, you'd want to be talking to them and getting this in train. It's no point coming to them at the end of December when it's about to fall due. Also, a joker in the pack here, November 2022. Remember, before this warehouse opens at New Year's Eve 22, you've got another income tax deadline in between next November, and there's no indication of any warehousing being available for that. So you'll have your balance of your 2021 plus your 22 prelim to pay in November. So if you think about that logically, next Halloween to Christmas time, you're going to have 3 pay-in. It's like having 3 pay-in files potentially to settle if you availed of both warehousing schemes, because you're going to have your normal November 22 interaction, and then you're going to have the 2 years that you warehoused coming into play at the end on New Year's Eve as such. So worth bearing that in mind. And those liabilities could straddle 4 different tax years, because you could have your 2019 balancing payment, all of your 2020, all of your 21 and your 22 prelim to settle between Halloween and Christmas. So certainly something better. And then of course, a lot of solicitors, leaving yourself aside, your practice might have warehoused VAT and PAYE debts during the last year and a half as well, which again, that warehouse opens on New Year's Eve 2020 or New Year's Day 2023 as well. Should you consider paying some of this down during the year? Possibly, you know, good to make a dent into it. But as a tactical measure, you might consider, if you're sort of disciplined and happy you can do this, you might consider setting money aside yourself and ring fencing it. And then towards the end of 2022, you have a war chest to go to revenue with, and offer that to them as a down payment with the balance on a phased payment arrangement. Because when revenue enter into those PPAs, they do look for down payments. Traditionally, they used to be 25%, but for the last number of years, the revenue's opening gambit has been 40%. So just be careful that it may make sense to actually build up a war chest to offer the down payment. It's a bit of a tactical decision, I suppose. We have an example here, which is John, a solicitor. So John, in the last glory year, 2018, had, let's just say, 100,000 in tax, all settled in 19. All was good in the world in November 19. Says, I'm going to have a better year in 19. I'll have more tax now to pay next year. And of course, then the world changes. He comes to November 2020. His bill for 2019 is 150. He's made his 100 down payment the previous year, so he owes the 50 for that. He's had a bad year in 2020 with coronavirus. His income is more than 25% down. So he says, I'm going to warehouse 100 grand of a liability in 2020. I'm not going to pay my preliminary in respect to that. I'm not going to pay my balancing payment for 19. Then comes to 2021. It's steady as she goes, still at that lower level, hasn't recovered, but hasn't got any worse. So he says, I'm still down 25 on relative to 19, so I'll warehouse again. So what he does in November 21 is he looks at his 100 grand and he says, well, 90% of that is 90K. I'll warehouse the 90K. So at this point, he's got essentially a total of 240 in the warehouse, and the doors of the warehouse then are locked and will stay locked until December 22. But then when John lands at next Halloween, he says, oh, November 22 pay and file. So now I have my 2021 balancing payment. I didn't pay any prelim last year, but I did declare 90K and locked it into the warehouse. So I owe the balance here, the 100 essentially minus the 90 is 10. So he has to pay his 10 grand. And he has to pay preliminary tax as well for 2022, which we'll say he bases on 100% of 21, so 100. So he's a 110,000 euro outlay at Halloween. And then January 23, the warehouse opens and he has the 240,000 euro worth of debt falling due. So you can see how he has 350,000 accumulated. So this is a guy who broadly has a tax bill of about 100 grand a year, slightly higher, for example, of course, for 19, but he's at that level, and he's suddenly finds with 350,000 to pay. And if he warehoused his VAT and PAYE as well during the coronavirus era, that is also falling due on 1 January 23. So you could have a hell of a tax bill to settle. So clearly careful cash flow planning and interaction with revenue would be advised.
Yes, very, very good, Michael. We're just running into the last minute, so if anyone has a quick question, we'll take it. But I think that last slide really just sums up how, you know, how an average income earner in this area could end up with having a significant tax liability if it's not managed
it's
carefully
sobering,
and appropriately.
Yeah.
So
yeah.
I think that idea of ring fencing some money off yourself and then being able to go to revenue is very very opportune. I mean, the alternative is to pay it as you go along, but that money put down may not be to your advantage because they'll still seek a down payment despite you having reduced your tax liability.
That is the danger. You'd hope that they'd be realistic or reasonable and agree to treat those on the drip payments as kind of a contribution to a down payment, but you know, there's going to be a lot of debt that they're going to be trying to settle this time next year. So, you know.
Listen, Michael, unfortunately, we're out of time. Thanks very much for joining us today and giving us your summary on the budget, on making tax returns and making and how to deal with tax warehousing. It's a subject that I'm sure we'll come back to on Friday.